Hey everyone, welcome back to the channel. Craig here with Swanson Reserve Capital. Today we're going to talk about structured notes versus world-class soccer. So I don't think there's huge difference between sports and investing. I've played sports since I was 3 years old, specifically soccer, and it has stayed with me from different principles I've learned in the game, and I've brought that into investing. What are some of those principles? So one of the ones I want to talk about, and I'm not going to go through this entire deck because this is really just to cover income notes, but what have you heard a ton of coaches say over the years? And a defense wins championships. That is very similar in investing. You need to understand that in the game of investing, we think defense is the best offense in investing and not losing money. So here's how we create our defense to win championships with structured notes of the income variety. So income notes can be compared to our stellar defensive players. Their primary goal in our fund is to prevent losses while generating income gains on a monthly basis. So it's something that pays out distributions the month after you invest, and their role is for us to create and buy the right players, the right securities, stocks tied to these securities. And similar to the other team moving against us, we won't want the market to move against us. We don't want our securities to fall below the protection features, and we build very heavy protection features in. So all of our income notes, they play a lot of defense. They have at least 30 on any index that we're buying % downside barrier protection. 50 is what we strive for any equities attached to them as defense. So similar to players having contracts in this game of soccer and sports, our structured notes have terms. And so I'll talk about those really quick. But to put it very simply in perspective, as long as you have structured income notes that do not fall within the coupon payment protection, just generally 50%, 40% on the equities we're buying, you will, as your defense holds up, collect income payments. We talked about this. What happens though if those barriers breach? What happens if they go through those protections? Well, as background, we buy our structured notes on the income side for 3 years. Anything can happen within inside of 12 months, 18 months in the stock market. History has shown us that. So understand that if you're going to invest in these type of products, your money would be tied up for 3 years, but you're going to get paid out you'll start seeing those payments within the next month. Now, we generally distribute from our fund on a quarterly basis, and that creates income while we buy our growth notes, which are a one-time payout, generally over and above 17%. So these are really high yielding. I think we're not shooting for 50% or something, generally unrealistic that any fund or ETF or investment has yielded each year. But again, what happens if those barriers breach? What happens if it goes down, right, Craig? Like, what if it goes tanks? Well, here's a really unique feature we put in. So one, in investing, just never panic. Understand that your investment is for the plan in which you put that money in for, in this case, at least 3 years. But barriers are not the only protection that we use in our income notes. There is something called 1-star, meaning if 1-star player, stock or index, scores 1 goal, aka is up 1 penny at the end of that term, all of your principal investment, everything you put in, is protected. That investment will not lose any money. Even if you have something on Tesla, Amazon, and Apple, which is an example of a note we have, Amazon could go out of business, Tesla could go out of business. As long as Apple is up that 1 penny at the end of the term, your investment is protected. So to bring this home in relationship to soccer, you could still lose the game just like the players do on the field, but you can still get paid. The key is, and the key risk, of course, there's risk. There's credit risk, which is JP Morgan, Goldman Sachs, Citibank going out of business and not meeting their debt obligations. We think that's very low. We could let you determine whether you think that's a high probability to happen. The significant risk occurs if the underlying assets, aka players, consistently fall below the barrier over a 3-year period. Now, relative to soccer, it's like getting beat 6-5 over a 3-year period and getting sent down into that relegation, and you're just getting crushed. Now, we're buying what we believe, and we're doing our testing on high probability that these will not fall below those barriers. Oftentimes well above 80 to 90% that will not occur. So we like those odds, and that is the reason why we put together one of the first structured product funds. Thanks again for your time and attention. Hope you found this interesting. Drop any comments below and make sure to follow us on our social LinkedIn channel and here on YouTube.